सेव किया था ना?
मैं सिर्फ इसलिए गया था क्योंकि उसने मुझे कॉल किया, that's it. But listen तो.
Save it for someone else.
जिंदगी में सेव करना जरूरी है, मगर जब बात पैसों की हो सिर्फ सेविंग से काम नहीं चलेगा। इक्विटी म्यूचुअल फंड्स में इन्वेस्ट कीजिए और अपने सेविंग्स को आगे बढ़ने का मौका दीजिए।
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.
Regular viewers of Macro Sutra and before that Economics know what our position on public sector banks have generally been. I will not try to remind you. If you're regular viewers, you know what we have said about public sector banks in the past and in comparison especially to private sector banks, and how much private sector banks are much better in terms of service, in terms of performance and a lot of parameters. But something is happening to public sector banks in the last couple of months, especially this year. They are putting up a stellar performance. All performance parameters are turning around and things are beginning to look up, so much so that the stock market investors are so excited about public sector banks. They are among the best performers, the best performing lot among banks, even on the stock markets. So what exactly is happening? Why are they beginning to shine finally? What are the underlying reasons and causes? That is what we are going to discuss today in Macro Sutra. Hello and welcome. I'm YP Rajesh, managing editor at ThePrint. And this is also a very special episode of Macro Sutra for me, because for me, this is going to be the last episode of Macro Sutra as I'm moving on. Macro Sutra will continue. Radhika will be there. But for me, this is the last one, and I want to thank all our viewers for being there and asking questions and making it so much enjoyable for me. Let's go straight to this big, exciting subject we are dealing with today. Radhika, what is happening? I mean, how has this turnaround come about? You know, in your piece published on Friday morning, you have talked about the various parameters. When did this change, this turnaround begin? When did you start noticing it?
So the most visible change we are seeing over the last 6 months, this quarter.
So 2 quarters.
But yeah, the 2 quarters since the beginning of this financial year. But the improvement has started to happen from 2018 onwards. So since 2016-17, a lot of regulatory measures were taken, starting from the asset quality review, which was introduced in 2015, but it started having its impact on the balance sheets of banks from 16 onwards. That plus the enactment of the Insolvency and Bankruptcy Code, better regulatory norms by the Reserve Bank of India, where banks were asked to recognize bad loans on their assets. That plus on the corporate side, a lot of deleveraging happened. Like companies started to repay their loan. So it's a combination of a number of factors, better regulation, deleveraging, repayment of loans by companies, IBC. A lot of these factors have been helping in improving the balance sheet position of banks, which public sector banks, which traditionally have been saddled with big stock of NPAs. Normally, if you just compare with the NPA position of public sector banks and private sector banks, we see that public sector banks have higher NPAs. One of the reason is that they are the biggest lenders. 60% of loans is advanced by public sector banks. So we will see more bad loans in public sector banks. That is true. But over the last couple of years, a series of developments have happened. Also mergers of banks, mergers of some public sector banks. That has also resulted in economies of scale, better operational efficiency. So these are some of the medium-term measures. But on the immediate front, if we see the interest income of banks has improved because of the interest rate hikes by the RBI. So we know that Reserve Bank has hiked rates by 190 basis points. The policy rate has been hiked. Most of the loans now are benchmarked to the policy rate. So when the policy rate goes up, the lending rate also go up. But deposit rates do not go up in that proportion, in that pace. So we see that the interest income of banks has increased. So amongst the various reasons, the profit has increased. One of the main reason is that the income has increased, and within income, it is the interest income that has picked up.
Would it be right if I say that the transmission has been very convenient? Only one part of it has got transmitted very well, and the banks are benefiting.
Yes, so that has, a monetary policy transmission on lending has happened, particularly because now the loans are benchmarked to the policy rate much better than previously because of various changes introduced. Deposits have also increased, but not in the same proportion, and therefore, while the costs has also increased, but the interest income has increased more, and therefore profit has picked up.
I just look at the number you mentioned for State Bank of India, 74% quarter on quarter, 89.4% for Canara Bank. I mean,
this is all year on year. So one of the reason we must be aware, this is also base effect. July to September of 2021 was not very good. So that is also one reason. But nevertheless, even quarter on quarter, things have looked really impressive on most of the performance metrics.
And asset quality has also improved.
Yes, asset quality has improved. So one is the profitability. Asset quality, where we measure asset quality in terms of the gross non-performing assets as a percentage of loans, as a percentage of advances, has also seen a sustained decline for most of the public sector banks. And this is again an outcome of better regulation, better norms for asset classification. Like earlier, if we just go back in time, we consider the regulation that were in place during the global financial crisis. A lot of regulatory forbearance was announced during that time to help the borrowers borrow money from banks. But what happened was that continued for quite long, because that resulted in it was also easy for banks to not show bad loans on their balance sheet. That was a kind of incentive, distorted incentive that they also had. So they used to lobby that this, forbearance, the relaxation of norms should continue for more years. So it did continue until 2015. We saw that. And then when the actual recognition happened, we saw a big spike in bad assets. If we look at 2017-18, NPAs peaked to 11%. Now it is, overall it's less than 6%, but during that time it peaked to 11%, and for public sector banks it was even higher at 14% of advances. So all those things then started improving. Then during COVID also regulatory forbearance was announced, relaxation of norms, that okay, for some time you can restructure your loans, you can postpone the repayment of principal and interest, you cannot use, for some time you don't recognize bad loans on your balance sheet. So a lot of these measures were announced, but the good point this time was that it was for a specific duration. It was announced, and it was very targeted. It was for those loan accounts which had to show that they have been affected due to pandemic. So that way credit culture improved during these forbearance measures, and it was anticipated that again we will see an episode of rise in NPAs. That did not happen.
2 points, actually one main point that comes to mind when we talk about the performance of public sector banks is also, and it's also a political point, and we have clarified that, and we will share that article with you, the difference between write-offs and waivers. A lot of bad loans have been written off, as in taken off from the books.
Right.
But it's not that they've been waived. The banks continue to try and recover them.
Yes.
How much has that played a role in this performance?
Yes, so that has also played a role, because if we go by the data, for the last 5 years, around 10 trillion rupees worth of loans have been written off. And out of which the lion's share is for public sector banks. Around 7 trillion worth of loans have been written off by public sector banks.
That is 7 lakh crore.
Yes.
7 trillion is
7 trillion is 7 lakh crore. Yeah. So they have been written off. But as you rightly mentioned, the recovery process still continues, and they are shown as loss because the chance of recovery is very slim. So it is shown as loss on the balance sheet, and it is removed from the books of the banks. But going forward, I think those things will also improve now with the setting up of, hopefully, those things will also improve with the setting up of bad bank. Once it takes shape and once it operationalizes, it takes over some of the bad assets of bank. I think that process, the pace of waiver will also get tapered off. part of it is also due to COVID, but I think that will also narrow down over the coming quarters.
So how much of a role has IBC played in this? Because when you talk of NPAs and you talk about write-offs and banks are recovering, banks are taking haircuts, but they're getting some money back.
Yes.
So IBC has helped?
Yes, IBC has definitely helped.
IBC is Insolvency and Bankruptcy Code.
Yeah, so it was enacted in 2016 for the purpose of swift and prompt resolution of stressed assets. And for deposit-taking institutions like banks, it is extremely important to have swift resolution of stressed assets. And it did help, because if we look at the frameworks prior to the IBC, what we had the SARFAESI Act, we have the Debt Recovery Tribunal, we had these frameworks which did not actually help much in recovery. The recovery rate used to be very small. The haircuts used to be enormous. But now with the enactment of IBC, there are certain timelines, and it has also propelled RBI to do better, because after the enactment of IBC, RBI has also made some legislative changes in its Banking Regulation Act. So the 12 big accounts the banks were instructed to resolve those 12 big accounts under IBC, through IBC. And so that also happened, that helped in a lot of recovery. And after that, in 2019, the Reserve Bank of India came up with something called a Prudential Framework for Resolution. It's a principle-based framework for prompt and swift resolution. So IBC in itself helped in prompt resolution because it's creditor first. It's based on the principle of creditor first. And it also propelled better regulation making by RBI and instilled better credit culture amongst debtors, because they also know that now they have a well-defined framework, so they have to pay back. And the data shows that the recovery rate has improved. If we look at the data prior to COVID, 40 to 45% recovery we see through IBC. For 1 year, it was suspended during COVID time, but hopefully, I think this framework has also helped in better balance sheet position of banks.
One of the most interesting things I found in your piece, Radhika, we will be sharing that in the description of this video, the link to her article. You talk about good repayment behavior, that, a lot of people who borrowed money are returning it promptly on time with interest or whatever they're supposed to do. We always talk about NPAs, bad loans, defaults and all of that, but to say that there is a good repayment behavior being noticed is good news.
It's good news, yes. So, in fact, those borrowers who took the forbearance measure, the emergency credit line guarantee scheme, which we know that was announced during the COVID time to help the MSME borrowers. So they were given loans with guarantee. And so there is a study by TransUnion CIBIL which shows that the NPA rate for these loans has been minimal. It has been lower than the industry average. So it's less than 5%. It's around 4.8% as of 31st March 2022. So the kind of the fears or the concerns that were at that time, that there would be a lot of NPAs, there would be slippages from restructured assets to NPAs, all that, those concerns did not actually materialize, and we do see better repayment culture. We do see, and that is reflected in better asset quality of banks.
My last question before we go to our viewers' questions, Radhika, is this just a flash in the pan? Is it the peak and then things start plateauing, or will this growth continue? What are the challenges going forward? Because you also talk about margins being an issue.
Yes. Right now we are seeing a golden run for public sector bank. Now what will happen is that we already know that there are indications that going forward the interest rate hikes, the pace of interest rate hikes will moderate. By some estimates now there is this talk that RBI will now hike by 35 basis points only. The pace of interest rate hikes will narrow. What banks now have to do is that they have to garner deposits. Because what we have been seeing is that banks have been aggressively, they are in need of funds, they are grappling. We talked about liquidity position in one of the earlier episodes. That is one reason. There is tight liquidity position. Banks have been borrowing through short-term instruments like certificates of deposits. They have to offer higher rates on their fixed deposits and all. And as a consequence, what we are seeing is that there is a movement of deposits from current account, saving accounts to fixed deposits. So that will also, because CASA, current account, saving account, we call it CASA, these are low cost deposits where the interest rate is low and it's reduced to 3 or 3.5%. So people are, because of high interest rates on fixed deposits, people are migrating from low cost deposits to fixed deposits. That will increase the costs of banks. Some of the banks have expressed that concern that going forward their cost component will rise because they have to offer higher interest rates on deposits. The other competition that they will have to face is through other liquid instruments like mutual funds, because mutual funds are, especially the debt funds, mutual funds who invest in the debt instruments or the debt securities, they also have started offering higher rates. And we know that now retail investors are investing in stock market also. There is a big churning happening. So that is also happening, that there is a migration of savings from banks to other stock market instruments. So banks will have to offer high interest rates, and they will have to adjust to this changing situation.
We have a lot of questions, Radhika. Public sector banks always get our viewers very excited, and good to know that. And there are questions without names, but I will take the questions with names first and then go to people who have not given their names. First one is from Ashutosh Zaware. Hello Ashutosh, public sector banks are shining now, but will they maintain this performance? We just answered that question, Ashutosh. Hope that satisfied you. Second is from Jayant Deshpande. What about Mudra loans? Are these loans being returned in time?
So Mudra scheme was introduced in 2015 to give loans to small businesses. So if we see the latest data, which is available for the last financial year, financial year 2022, FY 2022, the NPA rate has moderated from FY 21. So it was 3.5%, it has come down to 3.17%. So as of now, the NPA position does not look alarming for Mudra loans. So because over the last 2 years, we have seen a moderation, though it is still higher than the pre-COVID level, the rate of NPA, but it is on the declining trend. And given the repayment culture, or if the economy opens up more and with better demand conditions, business prospects improving, I think the repayment will improve further.
Okay. Sankalp has this question. There are two things here, he says. Current period profits performance and write-offs of the previous periods. Could you please clear the air on these two so that the vicious propaganda from various political spectrum is put to rest? Is there any evidence to suggest that the banks may have been more risk-averse or prudent after 2016? And did IBC play a role in the turnaround? IBC we already addressed, but please clear the air on this past performance and post 2016 prudency.
So post 2016, we have talked about the various reforms. Yes, banks have become much more prudent in advancing loans because the regulatory norms have turned more stringent. They have to recognize if the 90 days overdue, they have to recognize it as an NPA. They have to have adequate provisions. We say provisions, that they have to set aside some amount of money for the different kinds of assets, like doubtful assets, substandard assets, standard assets. So all these norms have become stringent and they are being monitored on a regular basis. So because of that reason, the practice of extend and pretend that we used to see in the pre-2015 period we don't see that much happening now. Banks have become much more cautious and prudent in lending. That is one. And coupled with that, the fact that the companies repaid a lot of their loan, that also helped in improving the asset position or the asset quality of bank. That is one. response. And the other is about the write-offs and profits. Definitely, if we see write-offs over a period of time, we saw for the last 5 years, write-offs has been to the tune of rupees 7 lakh crore for public sector banks. If we measure in terms of assets, overall the assets of banks, it's less than 5%. So that is there. Write-offs has happened. There is no, we cannot deny that fact that write-offs have not happened, but given even notwithstanding that, we have seen that the profits have improved because of better quality, because of better provisioning. You see the provision coverage ratio. Banks have made adequate provisions, so that will help them safeguard against future anticipated erosion in loans. If they are not, if borrowers are not able to pay, they have adequate capital. They are capitalized well. Recapitalization happened over the last 4-5 years, but now recapitalization has stopped and banks are raising finance from markets. So on all the other parameters also, banks are comfortable. So going forward, I think the ability to withstand shocks, to absorb losses will be much better as compared to the previous years.
Okay. So the first question from a questioner who has not shared her name. Do you think this is a result of a merger of a lot of public banks which took place in 2019? And do you think this merger strategy can be adopted in any other public sector as well, where there are heavy losses? How effective is the merger policy compared to disinvestment? Too many merger questions, but yeah.
Yeah, so merger did help. Merger is one of the factors that helped in improving operational efficiency and economies of scale. But we cannot attribute the turnaround, the visible turnaround that we've seen in public sector banks just to mergers. That is a combination, as we've discussed, of a number of factors starting 2015. So all those factors cumulatively helped in improving the balance sheet position of bank, and it further improved due to the rise in interest income of banks. So that is the point, because we saw that there was a time when half of the public sector banks were in the PCA framework, the Prompt Corrective Action Framework, which means that they were either not adequately capitalized, their leverage was very high, so they were put in an enhanced regulatory watch for some time. And over the course of years, their parameters have improved, and they are now out of the Prompt Corrective Action Framework. So it's a medium-term phenomenon starting from 2015-16 onward, in which merger also played one of the contributory.
So what do you prefer, merger or disinvestment?
Disinvestment, definitely disinvestment, because the factors, the reasons why public sector banks are saddled with bad loans will not go away only with mergers. So that would require disinvestments or privatization of banks.
Does merger work for other public sector? But
I think now that scope is over. They have already, the consolidated merger has already happened, and now we have a set of public sector banks where the scope of mergers is limited.
Next anonymous question is, how much contribution do you think raising of interest rates has made in the rise in profits, as logically bank income would increase with the increase in interest income from banks, from loans? We have answered these questions. It has played quite a big role.
It has played a role, because if we look at the balance sheet, there is interest income, there is non-interest income, and interest income has increased dramatically since the interest rate hikes by the RBI, and that is one of the reasons why profits have also picked up.
There's one more question on mergers, Radhika. It's not been framed correctly, so I will try and interpret it to the best of my ability. And this was also my question I wanted to ask you. Are there too many public sector banks in the country, or more than what we require? Do you think more mergers are needed? When can we expect banking and financial reforms?
So on mergers, we already talked that a comprehensive set of mergers did happen. I think now we do not have much scope. It will require looking at the asset size to further make some estimates about whether mergers are needed or not. But on what kind of further reforms are needed, I think one reform that was introduced over the last year was the setting up of the bad bank, which is called the NARCL, National Asset Reconstruction Company Limited. Only thing is, it hasn't started. We need to see how far it is effective in taking over the bad loan, and whether we will have a active liquid market for stressed assets where banks are able to get a good recovery for the bad loan. That is one. The other thing which has been which requires the attention is the setting up of resolution corporation, which we, I think in the previous episodes of Economics, there has been discussion about setting up of a resolution corporation for prompt resolution, like we have IBC for non-financial firms. For financial firms also we need something like a IBC framework, which is the resolution framework for prompt resolution of troubled banks going forward, because the ability of State Bank of India to absorb all the losses will also get limited over the coming quarters or the years. So we do need an active framework, especially for small private banks also. We need that framework for swift resolution of troubled banks.
Last question, Radhika. How are public sector banks of India doing so well, or at least supposed to do well? I mean, he's not convinced or she's not convinced, when major economies like UK, other European countries are facing a lot of trouble due to recession. And if the situation worsens there, will it not affect Indian public sector banks?
See, here the public sector bank's position, or overall the banking sector position, has improved because of the better credit. Credit disbursement has been very impressive. Even going by the last data, we know that the year-on-year change in credit was 17%. So long as there is demand for credit and coupled with higher interest income, we will see better profits by bank. Yes, some amount of impact will be felt, and that is felt on the non-interest income of banks, brokerage and other actions or the activities that banks undertake in the other countries. But that is not the prime line of business of Indian banks particularly. So here we are more influenced by the domestic conditions, and as of now the credit growth looks robust, and it is expected, even if we look at the the analyst presentation, what banks anticipate. As of now, it is good, but what will happen over the next, say, a couple of quarters? They still expect credit growth to be somewhere between 14 to 16%. So if the credit growth is going to be above 15%, it will mean that the interest income of banks will rise, and the quality, the balance sheet position will remain strong.
More credit growth, more interest income, balance sheet will remain strong. That is a good prognosis for the next couple of quarters for Indian public sector banks. And that's a great note to end this Macro Sutra on. Thank you so much for watching. It's been a personal pleasure for me. But stay with Macro Sutra, stay with The Print. And next week there will be a new episode. Take care.